2026 could blindside Calgary homeowners. Interest rates might rise, jobs could fall, one wrong assumption, and you're stuck with a property you can't afford or a market you can't enter. Let's talk about what's coming and how to stay ahead of it. Today, I'm doing something different. I'm not making a full year prediction, and I'll explain why. But I am going to show you the key risks everyone needs to watch in 2026. Last year, at this time, I predicted Calgary home prices would rise about 1% in 2025. I was conservative compared to other agents calling for 5 to 7% growth. We were all wrong. Prices fell 2%. And here's what matters. Whether you predicted big gains or modest gains, we all missed the direction. Sales dropped 16%, inventory surged 60%. Nobody saw that coming. So here's what I'm doing differently. I'm not making a full year prediction for 2026. Not because I'm scared to be wrong, I'm fine with being wrong, but because the world is too unpredictable right now. And pretending I can see 12 months out isn't serving you. I mean, look at what just happened, okay? Interest rate expectations reversed in 3 days. We went from pricing in cuts to pricing in possible hikes by late 2026. Think about what could change everything in 2026. A possible federal election with major policy changes, fingers crossed. This trade war with the US continues. Alberta's energy sector swinging on oil prices, immigration policy reversals, Bank of Canada changing course again. This is what I mean by blindsided. Making assumptions based on 2025's playbook could leave you on the wrong side of the market in 2026. So instead of predictions, I'm going to show you the key risks to watch, what the data says right now, and how to position yourself no matter what happens. So, risk number 1. Interest rates could rise, not fall. Let's start with the biggest assumption people are making, that rates will keep falling. As of this week, bond markets are pricing in higher odds of rate hikes than rate cuts for late 2026. Why? 3 consecutive months of shockingly strong job data. GDP growth beating expectations, inflation concerns returning. For Calgary homeowners and buyers, this changes everything. No, I want to be clear. I don't believe in any of that. I think the jobs are shit. I think GDP growth is going to stagnate. But if you're a buyer waiting for rates to drop 2.5%, stop waiting. That's not happening. Maybe. You might see 1 to 2 cuts in spring, but the downward trend has stalled. If you're renewing your mortgage 2026 is the peak renewal year nationally. 31% of mortgages renew this year, and 25% of borrowers will see their payments rise over 20%. If you're one of them, you need to know your numbers now, not in 6 months. If you assumed affordability would improve, it might not. If rates stay flat or rise, affordability could actually worsen even if prices soften slightly. This is assumption number 1 that could blindside you. Don't assume rates are going down. Risk number 2. Jobs could fall despite strong headlines. Now, let's talk employment, because if you lose your job, nothing else matters. I'm very skeptical about a lot of these rosy job numbers posted lately. You can watch my latest jobs market video here, and I will have another one coming with the latest labor market survey, but Alberta saw massive job gains in November. But here's what I'm watching. Are they permanent or temporary positions? Energy sector hiring tied to volatile global commodity prices. This is the assumption number 2 that could blindside you. Don't assume employment stays strong. If unemployment rises, distressed sellings increase, inventory spikes, and prices could soften more. Risk number 3, assuming all property types perform the same. When you hear that the market is falling, not all Calgary real estate is equal right now. If you're making decisions assuming the market moves as one unit, you're missing critical differences. So ending December 2025, detached homes, the annual average benchmark price was $752,767, 1% higher than last year's average annual level. Semi-detached, the average annual benchmark price was $685,850, nearly 3% higher than 2024. Row homes were down 2% to $441,217. Apartments were down 3% to $322,167. So they're seeing the most pressure. And to be clear, these were the average annual benchmark prices. So here are the benchmark prices as of the end of December. Let's talk about why apartments, condos are struggling. We're seeing purpose-built rental completions at record levels. So investors are shifting units from rental back to resale, and we have the highest inventory relative to demand. The detached market isn't falling as fast as people think. It's actually holding relatively well. Geographic variation matters too. I mean, the Northeast is down 8%, but the city center is relatively stable. This is assumption number 3. Don't treat all Calgary real estate the same. A condo in the Northeast faces completely different market dynamics than a detached home in the Northwest. So let's look at the actual December stats. So sales were at 1,126 units. That's down 14.6% year over year. New listings were 1,219, down 1.5% year over year. Inventory was 3,860, so up 28.9%, and months of supply was 3.43 months. Benchmark price was $554,700, down 4.7%. So we want to take a step back too and look at 2025 as a whole. Sales for the year were at 22,751, that's down 16%. Inventory surged 60% year over year, and the annual total residential benchmark price was $577,492, so down 2%. We're in a balanced to soft market as we continue into 2026. Not a crash, not a boom, balanced with downward pressure on price, especially in the apartment condo market. Here's what's interesting. January feels busier to me than last year. More showings, more inquiries, more activity. But the actual data, we're behind last year in both sales and pending sales for the first 11 days of January. This is the disconnect. Activity doesn't equal transactions. People are looking, but at least on the buy side, are much slower to write an offer on a property of interest. When we talk about how 2026 will play out, the key variable is employment. If jobs hold, we stabilize. If unemployment spikes, we soften further. But here's how to position yourself based on what we know right now. Know that homes fluctuate in value. If you're buying with the assumption that it will never go down, you probably shouldn't buy. We aren't going to see the short-term price appreciation we saw the last few years, so don't expect that. If you're waiting for rates to hit 2.5%, well, tread carefully because that may not happen. If you're assuming prices will fall dramatically, be careful because detached homes are holding their value fairly well. Timing the market is tricky and you don't know prices have hit bottom until they start to go back up again. If you're a serious buyer, focus on finding the right home for you and your family long term. Take your time, negotiate on everything. Focus on properties listed 30 plus days if you can. The most room to negotiate are on apartments and row homes. Now, get pre-approved, but don't overstretch. You should never do this in any market, like stay within your means. Think long-term, location, rental demand potential. If you're selling, don't get blindsided by outdated pricing. I've said this before, but sellers are slow to react to market changes. It's tough knowing what your neighbor got 6 months ago and realizing that that is not today's pricing. But buyers react super quick. So don't waste time sitting on the market at the wrong price. I hate to be the one to say this, but no buyer cares what you need to get from the sale. Nor do they care what you think market value is or a fair selling price in your eyes. Market value is determined by the market, not you. Price strategically. If you're selling a condo apartment, price aggressively. Presentation matters more than ever. Spring brings more traffic, but more competition. If you're moving anyway, don't wait. Conditions may not improve. If you're a move-up buyer, you're potentially in a sweet spot. Entry level is still relatively competitive, and the upper ranges have more negotiating room. So the spread between segments has narrowed. Detached are holding value better than attached. Look, I know I just laid out a lot of risks, but here's the positive perspective everyone needs to hear. These market conditions, this is actually healthy. Housing in Canada has become overinflated. Prices detached from local incomes. What we're seeing now is a correction. The market is rebalancing. Lower prices equals better affordability, equals more first-time buyers, equals a healthier, more sustainable market. And here's what's incredible about Calgary. Even with everything happening, we're still one of the most affordable major cities in Canada. You can still buy a detached home here for what a condo costs in Toronto or Vancouver. The detached market here isn't collapsing, it's actually holding relatively well. So yes, sellers need to be realistic, but buyers, this is your opportunity window. First-time buyers are coming back nationally. Calgary offers incredible value, and if you're thinking long-term, which you should be, these are the conditions where smart buyers build wealth. My job isn't to predict the future or sugarcoat risks. It's to help you make informed decisions with the best data available. The people who get blindsided in 2026 will be the ones making assumptions. The people who thrive will be the ones paying attention. If you're looking to make a move in 2026 and you have questions, feel free to reach out. Thank you so much for watching. I really appreciate it. I hope you all had a wonderful holiday season, and I'll see you soon.